Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Netflix beats expectations for second quarter results, but the bar's high, and it may not be enough to keep the rally going. Plus, we'll hear from TSMC's CFO on business opportunities, the impact of tariffs, and much more in an exclusive interview. And a look at the expansion plans of defense manufacturing company Hadrian to help build AI-powered factories here in America. We speak to the CEO. I want to get to some news that broke in the last few minutes. JP Morgan, one of the biggest research shops on the street, is expanding its coverage to private companies, and that includes some of the most important tech startups. OpenAI is where their debut research has launched. So interesting. The analysts on that note saying basically they can't defend the moat that they have on LLMs. And in part, because of the no profitability till 2029, they're worried about how much patience investors have. Really interesting development when you track the private sector and the world's biggest startups. Let's get to earnings and Netflix. Netflix shares down significantly right now, 5% in the session. That's the most since the beginning of April as it stands on an intraday basis. But they beat on all of these classic financial metrics. Netflix has been saying for ages, judge us please, Wall Street, on these financial metrics, and they did great in the second quarter, boosting their outlook as well. The content slate looks strong, and the ad-supported tier is going to grow, doubling in 2025. Let's get out to Bloomberg's Lucas Shaw. He's the managing editor for Screen Time. That's our group that basically tracks the culture and our coverage of media entertainment. What was not to like with Netflix, right, Lucas? This is just like a high bar that's been set by Wall Street, and the company did really well.
Yeah, I think you nailed it with the high bar. Look, there was nothing in the results to dislike. It's not like they beat on any metric by some huge amount, but they beat on everything. I think it's a stock that has doubled over the last year. It's a stock that had been up by 40 to 50% so far this year. And it's even though it is now the most established and most valuable sort of pure play entertainment company out there, it still has this momentum behind it where people think it has a lot of room to grow. And so by most conventional, P to E ratio metrics, it's overvalued. And so if it only slightly beats, people just aren't as excited.
Netflix does this thing where it basically pre-records its earnings call and then dumps it as a YouTube video. This is what Ted Sarandos had to say on AI.
We remain convinced that AI represents an incredible opportunity to help creators make films and series better, not just cheaper. There are these AI-powered creator tools. So this is real people doing real work with better tools. Our creators are already seeing the benefits in production through pre-visualization and shot planning work, and certainly visual effects.
Lucas, I don't know how much attention the street was really paying to that commentary on AI. There was a lot of focus on the content slate, but did we learn anything new about Netflix's strategy going forward?
Nothing kind of macro high level. Ted has been pretty consistent on his views on AI, which is that it is a tool, it will be used, and it's not just about cost cutting. They think it can make product better. But I think what was new was him talking about using it on a show. Most of these Hollywood companies have been very wary of kind of sharing how they're using AI, unless it's in sort of a gimmicky way, like they're going to de-age someone for a character, or for a movie or show. Nobody gets too worked up about that. But this, along with this Amazon show, House of David, are probably the two highest profile examples, just given how important Netflix and Amazon are to the ecosystem.
Lucas, all over the socials is Stephen Colbert saying that the late show's cancelled. Do we know anything? What are the details here?
Well, we know that the show is going to end in May of next year, and it's not just Stephen Colbert leaving. The show, The Late Show, which started in, I believe, 1993, will cease to exist. So it's the end of an era in late-night television, and there will be a lot of speculation as to what happens next to Jimmy Kimmel's show or to the Tonight Show with Jimmy Fallon. CBS is really trying to position this as a financial decision. I don't think it would surprise anyone to know that ratings for late-night shows have gone down. The cost of doing it hasn't gone up, or hasn't gone down either. So the profit made from these types of shows is now very slim. Some might even say they don't make money. But it's hard not to believe that there is some political angle to this, given what has happened with the Paramount deal and the Trump administration, but nobody has any hard reporting on that.
I know that was a jump from Netflix earnings to the Late Show, but it's what everyone's talking about right now online. Bloomberg's Lucas Shaw, who leads the Screen Time team. Thank you very much. I want to stick with Netflix. Dan Kurnos, Benchmark senior analyst, joins us now. Benchmark currently has a hold on Netflix. What we didn't get into, Lucas, was the ad-supported tier. They're saying that is, in a sort of a revenue contribution terms, is going to double in 2025. But did we learn anything more beyond the financials on how the consumer is engaging with that ad-supported tier, Dan?
Yeah, can I actually just go back to something Lucas said for a second? I think that there was some nits to pick with relation to the report. I mean, if you wanted to be negative on the stock, you would basically say that almost all of the guidance raise came from FX and less from member growth and growth in monetization, particularly in that ad-supported tier that you just mentioned. And in addition, their engagement grew by only 1%, which, while it's been stable for the last 2.5 years, you've had the rest of Hollywood kind of pulling back on content spend. And so why are they not growing their engagement faster as they continue to spend, I think, $18 billion this year, and then growing that a little bit less than revenue going forward? So that's just one point I'd make. On the ad-supported side, yes, I think we did learn a little bit more last night. We learned that retention remains strong. We learned that ad-supported is now more than 50% of new signups. But we also learned later in the call and the callback that their pricing is improving on ad monetization. And so I do think if you wanted to be more positive on the story, you would say, okay, so even if most of the guidance raise came from FX, they still beat on member growth, which we thought would happen going to the print. And they also improved monetization on the ad-supported, which is going to be the long tail of the growth story. And so numbers for 2026 should also then move slightly higher.
There are going to be lots of people watching Bloomberg Tech right now saying, hold on, if Netflix was so good, why is the stock down 5%? And of course, as of last night's close, it was a stock that was up 43%, market cap of $500 billion, and that eclipses, your Disneys and your Warner Brother Discoveries by some distance, right? This is a company, would you say, that's in good health?
I think they're in fantastic health. I mean, they're the king of the streamers, right? You can argue YouTube, and you can argue YouTube monetization. You can argue how much room Netflix has to run. But by almost all engagement metrics, by subscriber metrics, they're dominating the streaming industry, and they're doing it, as opposed to all the rest of the companies that you mentioned, they're doing it profitably, and very much so. If anything else, they actually took up their operating margin guidance this year, and it continues to creep higher. And so maybe that's one of the reasons why they're not splashing out more cash on content spend. They're trying to do it in a thoughtful manner, which we saw others do in maybe a less thoughtful manner, and they're trying to dig out of their holes. So Netflix is in terrific position going forward. But as Lucas said, expectations are very elevated.
Dan, what are you watching right now on Netflix, and what are you excited about in the content slate?
Squid Games 3 looks super exciting. The new animated stuff they've got coming out, since we talked about that, really interesting articles out today about how also kids content is leading sort of the retention charge. So very interested to see what they produce, being a Family Guy here. Really interested to see what they produce down slate. But, there are going to be some unique events, fights in the back half of the year. I look forward to those. And then, of course, you've got the NFL Christmas Day games. And who could miss those, right?
That's a great summary of both the produced and live content. Dan Kurnos, Benchmark Capital Senior Analyst. Great to have you on the show. Now, let's get to some news overnight. Meta hired a pair of key AI researchers from Apple, not long after already poaching their former boss from the iPhone maker. Sources say that Mark Lee and Tom Gunter were hired for Meta's Superintelligence Labs team, and one of them has even started the new job already. It's all part of a scramble for AI talent across the tech industry lately, with Meta proving especially aggressive in its recruiting. That was another Bloomberg exclusive overnight. Now, coming up, we're going to have to take a look at how uncertainty over whether President Trump will fire Fed Chair Jerome Powell is impacting technology investors. I also want to get out to shares of crypto-related stocks and take a look at Bitcoin. This is more about stablecoin, but the Genius Act has gone through, the stablecoin legislation. Coinbase is actually off its session highs, up 4%. Circle's been volatile, but what we know is that this will be sent to the president's desk today and that there'll be a signing ceremony later today. Stick with us, we'll have much more on that. This is Bloomberg Tech. been another wild week in tech, particularly in financial markets, lurching on every twist in a saga around President Donald Trump and Fed Chair Jerome Powell. The president says he's not firing Powell, but somehow that statement still felt like a threat. That chaos has very real consequences for policy and for technology investors. Joining us now, Jiao, managing partner at Millennia Capital, and crucially, a former Fed insider and staffer who worked on markets and monetary policy inside the belly of the beast. Joe, it's great to have you back on Bloomberg Tech. You know what it's like being inside the Fed. You understand the independence of the Fed. But what have you made of this scenario as somebody that's now left the Fed behind and works principally as a private markets investor?
Yeah, look, I think the most direct relationship between Fed policy and technology investing and venture capital investing is the path of interest rates. And in particular, what that means is, interest rates have such a huge impact on valuations and returns in the private markets, especially as the companies go public. So now as an entrepreneur and investor running my own firm, I don't think as much about who's sort of driving the buzzer. Because ultimately macroeconomics is a very much a rules and sort of a principle-based sort of a profession. And whether it's this chair or another chair, the path of interest rates between A and B wouldn't be that much different, just because for a couple of reasons. One is there's also 11 other voting members in the room. And so in my book, rates are coming down, and whether they come down in July or September, the start of the cut, it doesn't really significantly impact private markets valuations. Also, in private markets, there's a lag of many months before asset prices adjust. In the stock market, that might impact post-IPO stocks a bit more. But to sum it up, in private markets, we're looking at often the path of interest rates to put into our financial models, and between this chair or another chair, the delta wouldn't be significant.
There's a difference, of course, of being a staffer or working at the Federal Reserve and then being an appointed official at the top of the Federal Reserve. But would you just reflect a little bit like what it was like to work there, research there at the time, and whether you or your colleagues would really pay any attention to the politics of the day?
To be honest, there's not much that the staffers could do. Now at the board level and the FOMC level, often, the board is, very influential, but there's still 12 other banks sort of in the room. And so, I think the last thing I'll say on this topic, because I worked there more than 10 years ago, and I was there during the transition from Bernanke to Yellen, and at that point you realize whoever was, if you were driving the bus, shouldn't impact monetary policy that much, because ultimately monetary policy is made on a set of rules, the Taylor rule, markets and the GDP and inflation. So that's why, as a result, as a staffer, you don't really pay that much attention to the politics. Now, on the private market side, I pay a little bit more attention to the chair because that will impact sort of the path of interest rates. But again, it just is not significant to what we do.
We've been using the phrase private markets, but you're also, almost to all intents and purposes, a venture capital investor, right? And the way that it's always explained to me is when you think about the makeup of the LPs, they might be high net worth individuals or family offices. They have a choice. Go with various assets where rates and the current yield on any given treasury is one factor. But they might also say, well, over a 10-year horizon, I want to get 100x on my investment or something like that. Just explain the mechanics of how that factors in.
Yeah, well, look, as a matter of principle, as an investor, there's sort of average returns you sort of expect. Like if you can always get 2 to 5% in money markets on average, because Fed funds is 2% on average, and it can go up to 5% like in the last couple of years. And then then you can sort of go into the higher risk assets like private credit, public credit, and real estate getting 8 to 12%. But then you often go down the risk curve and look for tech stocks and venture capital seeking 20% returns a year. Now, because the risk-free rate is sort of the alternative, the lower the rate, the more risk-seeking the average allocator becomes, and vice versa. So as rates are coming down, you would expect to see all things equal, sort of allocators should be allocating more into risk assets. This is sort of the opposite of what happened during QE. The point of QE was to suppress yields, to kind of force investors to go into risk assets. And so the last couple of years, that kind of went in reverse, and now we're kind of going back again.
Joe, we were showing your portfolio earlier. One of the names you're in, Scale AI, or were in, I think. Your reaction and your summary of that Meta superintelligence team and the acqui-hire of Scale.
Yeah, we're still a significant investor in the company. So to take a step back, in the last 18 months, we've deployed over 9 figures of capital into the AI foundational companies, and some of them are listed. There's others we didn't list on our website for NDA reasons, and Scale is one of those investments. And so I sort of, I've read a lot about what's covered in the press, and my take is I still believe in the long-term potential of that business for a few reasons. One is its business model is more of a SaaS and consulting business model, where who's at the helm impacts the company's future a bit less than if this were at a large language model company where the leadership team and the founding team and the engineers would account for a majority of the value. So, Scale has many large contracts from the government, from corporations, and these are recurring businesses. So after the sort of the transaction, and by the way, we received
Joe, real quick. We're short on time, but I really wanted to ask you about this. We reported that JP Morgan is moving into research of private companies, starting with OpenAI, that you have exposure to. Just 30 seconds, but you're going to read that research?
Honestly, public market investors tend to less understand private markets a bit more. I heard the show a little bit earlier. In private markets, companies are supposed to be burning cash. They're kind of like students in undergrad or in college. You want to be burning cash to maximize growth. So to whether the company becomes profitable in 2027, 2029 is probably not as important as the public markets research analysts make it seem.
Joe Jiao, Managing Partner, Millennia Capital, on all of the news of the week and the day. We really appreciate it. Thank you very much. So coming up, we're going to hear from the CFO of TSMC about the chip makers' efforts to expand into the United States. That's coming up next. This is Bloomberg Tech. Taiwan Semiconductor Manufacturing says it plans to remain prudent about spending this year, even as the chip maker works to build out production capacity in the US. TSMC's CFO Wendell Huang sat down exclusively with Bloomberg and discussed some of the risks for the Taiwanese company setting up in the US.
The same problems that we faced before. You have culture difference. Generally, it's more expensive here. All these things, they are facing the same thing.
For suppliers that are considering from Taiwan moving some operations to the US, what sort of assistance can TSMC provide?
We understand the challenges for these suppliers because we've been through it. So we brought these challenges to the attention of the government about permits, application, and things like that, the human resources availability. That's what we can do to urge the government try to solve this issue for the suppliers.
That was TSMC's CFO Wendell Huang, who you can check out the entire interview on Bloomberg.com. Bloomberg's Annabelle Drulers joins us now after conducting that interview late night in Taipei. There was so much more in it. What were the other key themes?
Yeah, I think if you were to sort of take a step back and think what was the key message out of these earnings, and I think in one word it was conservative, because TSMC, as we know, had a very strong quarter. They managed to lift their full-year growth forecast, for instance, to 30%. That was up from around 25%. And even when you think about how they performed in the first half of the year, their guidance for the third quarter, it's very strong and it's well above that. So the key question was sort of, what exactly is going to be happening in your fourth quarter and just how bad could it get as well. But essentially, Wendell Huang, he told me that they are just very concerned about the macro uncertainties. That really relates to tariffs, of course. And that also played into the CapEx story, which was another big talking point in the interview, because they've kept that at $38 to $42 billion. He said that they're going to be sticking with that, again, given those uncertainties, even though he said for a company of that size, you don't expect it to have any sort of big fluctuations year to year. So he still does say it's sustainable.
Annabelle, something really key to understand about TSMC, like it's the crown jewel of Taiwan, right? But it operates in Taiwanese dollars while booking its revenue in US dollars, hence the FX impact. How did they explain that to you and how it will manifest, I guess, throughout the rest of the year?
Yeah, that's it. I mean, Taiwan, or TSMC, as you said, it is the major company in Taiwan. It's by far the heaviest weighting on the local benchmark here. But as you said, it's got basically 100% of its revenue in US dollars, around 75% of its costs, its outgoings are in Taiwanese dollars. And in the past few months, there's been a rapid appreciation in the Taiwan dollar. So that's had a really big impact on the company earnings, because actually, if you had looked at them just in USD figures, the numbers would have been even stronger, but it was around a 4.5–5% hit for the period. But in terms of how they're managing this, well, asked about sort of the different hedging tools that are available to them. They said that they do prefer vanilla strategies, but some of the things that they're doing that he spoke about included selling Taiwanese dollars, or US dollars rather, in the spot market. They're injecting money. We've seen them injecting $10 billion, for instance, recently into TSMC Global, so that's a subsidiary. And then they also use forward contracts as well. So essentially just trying to manage those risks. But we actually do understand they're a very big Bloomberg customer as well, because they are trying to manage these basically on a daily basis.
Annabelle, super quick, summarize their AI demand.
AI demand is super robust. I mean, that was really, really clear out of these figures as well. And they're basically guiding for very strong demand from some of their key customers. Of course, we know that's Nvidia. We know that's Apple. And we don't really see so much optimism from them generally. But when they're saying things like robust demand, I mean, the market really needs to be paying attention to that.
Bloomberg's Annabelle Drewlers in Taipei. Thank you very much. Now, coming up, we're going to continue the tech earnings discussion with Martin Norton from Empower, a conversation that you do not want to miss, because looking at that calendar, my goodness, there's a lot to come. This is Bloomberg Tech. Welcome back to Bloomberg Tech. Netflix is worth recapping, right? The stock's down almost 5%. That puts it on track for its biggest drop since the first week of April. But it is a stock that was up more than 40% so far this year, in excess of $500 billion market cap, beat across the board, strong forecast, but a very high bar. And that's kind of a big factor. And the only real stock story that's out there in the market right now, though, got a couple of more to come. Now, what happens next? Big tech earnings on the docket. Next week, you have Tesla, and then you have Alphabet. And then it just comes thick and fast the week after with Apple, Amazon, and then much later in August, Nvidia. Earnings in the tech space is back in focus. Thank goodness. What are we expecting? Martin Norton, Chief Investment Strategist at Empower, is with us. It's my happy time, right? This is what we're so excited about. We get that granular detail on capital expenditures, on the big picture of what's happening with the customer base. What is it that you're most focused in on and zeroed in on this earnings period?
Well, you know what's interesting? When I reflect back on, it's been such a busy year, so much news. But one of the things that I think has been maybe appreciated by the market, but not appreciated as much by the commentators, is what a reinforcing narrative we've seen around AI. So, of course, we're focused on tariffs. We're focused on everything that's happening at the Fed. But if we roll the clock back to the start of the year and all the questions that were surfacing around DeepSeek, let alone concerns around where AI demand is, what we've really seen as the year has progressed is that CapEx continuing, and then also these nascent signs of AI demand and AI implementation, which has been such a boon for the hyperscalers in particular. So I think watching that AI narrative continue is especially important in this earnings season.
Team in New York, let's bring back the calendar. I just want to make one point on Nvidia, because Nvidia comes so late in the season.
Right.
But what I reflect on is that when Nvidia hit $4 trillion of market cap, all of the research I was reading was about how the data in the 90 days prior to that had basically shown that Nvidia's most important customers had that commitment that you just outlined on capital expenditures. Take that forward into this next period and bear with me. You know, is it just as simple as you need to see Alphabet, Microsoft, Meta continue to say we're committed to this for Nvidia then to have a great print when it comes around?
Well, I think that's the first derivative. You do want to see the customers showing that commitment, kind of reinforcing what they've suggested in terms of CapEx estimates, which are very tremendous, as we've seen. But then also that second derivative, which is what I think of as that AI implementation, both within the tech sector, but then for the economy overall. And I think as you start to see that second derivative, that demand come through, I think that is reinforcement for the picks and shovels for the NVIDIAs of the world.
The wild card is tariffs.
Wild card is
how are the analysts on your desks kind of thinking about that and modeling for that right now?
Well, you know, it's so interesting because if we're taking a look just at price performance since that bottom on April 8th, if you're looking at IT, you know, in particular, it's a 45% run. There has been this massive enthusiasm where the market is beginning to appreciate what's happening with AI and maybe a sigh of relief in terms of the resilience of the economy. But I think when we're taking a look at tariffs, we haven't really seen the full force of those costs come into effect. And so, of course, we want to see what happens with corporate earnings in Q2. But as I think about longer term and kind of this rollback of globalization, I guess my thought is, you know, longer term, what does this mean for corporate profitability? And, you know, there's revenue that the government is collecting that's coming from corporations. And so what that looks like, that is kind of the wild card in terms of how that weighs on Q2, but longer term, what that means for earnings.
Marta, I really appreciated you going back to reference that kind of DeepSeek moment in April where, long story short, markets were roiled by the performance of DeepSeek's model and the cost of it getting there. But one of the things that happened was there was a kind of a valuation reset on the Mag 7. Have they climbed back to a level where you're still like, or is there some interest to look at the Mag 7 in a portfolio right now?
Well, that's what jumps out to me. So when we're taking a look at valuations, what we really want to focus on is the extremes. So, for example, technology, if we're looking at its valuations, price to forward earnings over kind of a history for that particular sector, it is in those extremes. It's in those 9th, 10th deciles. But when we're looking at the Mag 7, we don't see that same, I guess, extreme valuation picture. So I think it's really that 1-2 punch that we saw for the Mag 7, first getting hit by the DeepSeek questions, then getting hit on the tariffs, that have made those companies a little bit more approachable in valuation. And when you think about the health of these companies, kind of their ties to AI and their general kind of strength within the overall economy, it's hard not to consider the Mag 7 a bit of an opportunity, at least offering a bit more margin of safety than some of the other tech-related names.
Marta, I'm going to go to a question I've not had the opportunity to ask for many months now.
Oh, good.
Which is how are you using AI in each of your sort of daily tasks at work, seriously, and which tools do you rely on?
Well, you know, it's a good question. I am a slow adapter, so, you know, I'm definitely representing more the tail or more the average of the investment community. And I do, you know, I'll use ChatGPT on the regular just to get a quick summary view of what things look like. Hey, give me the lay of the land in this, give me the lay of the land in that. And we're increasingly beginning to think about what we can do to automate tasks, especially that spreadsheet build, those deeper analytical efforts. What can we do to make that faster so that we can get the heart of the questions sooner and spend more time on the analysis? So I'm really thrilled about it, despite the fact that I'm a late adapter in most things. I think this is something that is really opening up the bandwidth to explore the more interesting stuff of my job.
I really appreciate the answer because, like, a lot of our audience are facing the same questions with themselves. Something we reported earlier in the program is that JP Morgan, basically the biggest research shop right on the street, is expanding its research coverage to private companies, and they're starting with OpenAI. What I wanted to ask you about that was, like, almost as like a private proxy, when you think about your own portfolio management, would you read research of those private companies to kind of think about the exposure your public companies have to that that name OpenAI, or just to inform like future investment opportunity?
I think that convergence of public-private is really important for the investment community. I think it's really tempting to say, on the private equity side, are we looking at a market peak or, getting tactical with it? But the reality is that so much of the U.S. market is actually private at this point. And so for us to really understand the dynamics of the public market, we have to have better understanding of the private market. And getting those, those bits of information, it's kind of an inefficient market at this point. So the more that we can dig in, the more systems that we can build, the more landscape that we can view, combining the public and the private, I think that will inform our analysis all the better.
Marta Norton, Empower Chief Investment Strategist. Great to have you back on the show. Thank you very much. Now, coming up, manufacturing company Hadrian announces expansion plans to help build out AI-powered factories here in America. This is the defense use case. We're going to speak to CEO Chris Power next. This is Bloomberg Tech. Defense manufacturing company Hadrian has announced it's raised a $260 million Series C that will be used to expand its footprint in California and Arizona. The company's building AI and robot automated factories across the U.S., utilized heavily in the aerospace and defense industries. Chris Powers, Hadrian CEO, joins us now. Chris, welcome to Bloomberg Tech. It's really great to have you on. One of your investors says that the product is the factory. Just explain that.
So we view our job as to reindustrialize the country. And from the 70s to the 2020s, we really offshored everything we possibly could. And it's this whole system of both our software powered by Opus, as well as this new American workforce that creates this factory system. And that is the real output to our customers, is what are we producing, how accurate it is, how on time it is. And this full stack factory autonomy and the new American workforce that we're enabling with that alongside is the most important thing we're building. And that's why we think the factory system that we're building with people and technology combined is the product.
Sizable round, interesting group of investors, Founders Fund, Andreessen, Lux Capital. Why the size of the round, the difficulty or not in raising it, and what you plan to do with it, Chris?
We're very lucky that we were open and shut within a small handful of weeks, less than a month. Really, that's just a credit to not my fundraising ability or the market. It's just the team's hard work over the last year. What we will do with this capital is, expand into Arizona with a new factory for our customers that's 4 times the size, as well as use that capital to hire more people so we can ship more manufacturing capabilities to our customers, both in aerospace, the defense sectors, commercial manufacturing, and obviously, the DoD as well.
In January of this year, I was with the Anduril team in Ohio when they announced and confirmed that would be the site of Arsenal 1. And part of the discussion I had with Palmer Luckey was, why not California? Hadrian also has this big footprint in California, but you've looked to Arizona for your expansion. I think that's really worth discussing.
Yeah, we will have, R&D in California, and we're not moving out of California. But one of the most important things is that we're creating thousands and thousands of new manufacturing jobs in every state. Arizona has been great to work with on the practical stuff like permitting, workforce, getting energy connected to the building, all these basic things that are harder to do in some states. So we're really happy to expand into Arizona, but it also won't be the last. Our goal is to have factories in every state and creating, millions of new manufacturing jobs along the way.
Chris, something that I think was kind of missed from your post and the announcement was what you're expanding into: welding, casting, additive. Is that just because that's where the demand is, particularly from the DoD and the defense apparatus of this country?
That's right. I think if you look at, pretty public information from the Secretary of the Navy or the Army in areas like shipbuilding, the nuclear force, munitions, there's these huge lack of skills in the country. We need millions of welders, we need millions of machinists, we need millions of quality inspectors in all these manufacturing capability areas. And we just don't have the skilled workforce at that volume anymore. And this is what we're really doing with Factories as a Service, which is combining technology to make people 10 times more efficient and enabling them. It's not about replacing workforce and manufacturing because we just don't have a manufacturing workforce anymore in this country. So we really need to combine the two things that America is best at, American software and the American spirit, to get this 10 times advantage over our global competitors. And yeah, we're working on those categories primarily because they're so important for areas like shipbuilding.
Chris, when your peers come on this program, Castellian, Saronic, Vanavar Labs, or the Anduril team, they frame it in the context of China's manufacturing prowess, its competence in areas like software and hardware. How do you think about China, and what is the sort of Hadrian mission statement with regards to China, if indeed you take it into consideration?
Yeah, we think that the arsenal of inventory is not deterrence. It's the ability to produce fast and onshore, not just in areas of defense, but in pharmaceuticals. And that's why you have to reindustrialize the country. And I agree, we've given the farm away to the CCP by letting them have all our manufacturing capability over the last 3 decades. And now we're in a position where that really degraded the skill set of the trades in the US. And this is why, building ships, building munitions, building machine components in this country is very difficult, because we kind of offshored that talent to the Chinese. I certainly think that, the US needs to be the strongest industrial power like we were post-World War II, again, in order to, prevent or meet that threat.
Chris, is your ceiling limited just by the idea that your core customer is the DoD? Or in the future, do you do business with these other primes and other startups as well? Very quick.
So all of our customers are, a defense startup or a space startup from day one, up to all the mega primes through that whole chain. The DoD has only been recently a part of our business, but we are working with the vast majority of, hardware startups all the way through to the, mega cap public primes and everything in the middle.
Chris Power, Hadrien CEO, really grateful for your time on Bloomberg Tech. Thank you very much. Now, I want to get to a story out of China. China's top venture capital firms are back in the market, raising over $2 billion in new dollar-denominated funds. Lightspeed China is targeting $400 million for deep tech. Monolith, which backs Moonshot AI, plans a second fund worth at least $265 million. At least 6 major firms are courting overseas investors, signaling renewed global interest in China's startup ecosystem, from AI to consumer tech. Okay, coming up, President Trump is set to release new AI guidelines. We're going to have all the details on that next. This is Bloomberg Tech. President Trump is expected to announce new AI policy guidelines calling for an easing of regulation and an expansion to energy sources for its data centers. For more, I want to get out to Bloomberg's Mike Shepard in Washington, D.C. What's the need to know here, Mike?
Well, the thing we need to know is that this will be the administration's most significant policy statement to date on artificial intelligence. It's been in the works for about 6 months. This is one of the first things the president set out to do upon taking office. He tapped David Sachs, the venture capitalist, somebody who's been on this program even just this week, to talk about artificial intelligence, to lead this effort, along with Michael Kratsios, another regular guest on this on these airwaves. And together they have been trying to turn away from what had been seen as a rules-heavy approach under the prior administration. They want to do something that will do more to ensure and speed adoption of this technology, while also still trying to set a few rules of the road. We're expecting the president to deliver remarks on AI at an event at the White House on Wednesday, July 23rd. David Sachs will be here. It's an event that's being put together with the folks from the All In podcast, where David Sachs is one of the co-hosts. And we're also expecting the president to be signing a few executive orders connected with all of that. It's not going to be as far-reaching a statement on the technology itself. This will be focused more on executive branch actions, yet it still will carry some weight, and we'll be watching it very closely here.
All eyes on Washington next week. I think that's fair to say. I see some breaking news this morning, which is that the House Select Committee on China essentially criticizing or reprimanding the president, allowing chip makers, Nvidia, the focus in being able to resume some limited chip sales back into China. What do we know?
Well, we're hearing from the top Republican on the committee, one of the toughest China hawks in town, really raising questions about this decision to allow Nvidia to resume sales of the H20 AI chip in China. Remember, the Trump administration had barred sales and shipments of that chip to China over national security concerns just back in April. But in the past week or so, we have seen that restriction lifted. And that was a huge win for Nvidia, but it prompted questions from John Molinar, the Michigan Republican who heads this committee focused on the competition and with China and the challenge that the world's second largest economy poses to the U.S. Now, Molinar is raising the concern that, look, if we allow these H20 chips to be sold once again in China, this will simply allow Beijing to acquire more capabilities in artificial intelligence, including some that could go to fuel its military and intelligence complex, Ed.
Bloomberg's Mike Shepard, thank you very much. Staying in Washington, the U.S. Commerce Department is set to impose preliminary anti-dumping duties of 93.5% on imports of Chinese graphite. That's a key component of battery manufacturing. I want to get out to Evelina Stoicu of Bloomberg NEF. Evelina, you kind of lead our analysis and in-house research of the battery supply chain. As a start, why would this penalty on graphite have impact? Why do we need to know about this?
Well, as you mentioned, Ed, graphite is a key component for batteries, and these tariffs would basically increase the cost of making battery cells in the U.S. Now, batteries are important for a variety of sectors, including EVs and stationary storage, and as the U.S. is pushing for more domestic production for battery cells, as it is a key component around energy, we're going to see likely increased costs. Most of graphite is coming from China, and in the U.S., around 75% of synthetic graphite imports, which is the type of graphite that is mostly used for batteries, is coming from China. So we expect a big impact for the battery industry.
When the news broke, I saw that Tesla shares fell significantly. They're now up higher in this session. But one of the things I was thinking about is for those U.S. domestic battery manufacturers. I was at Panasonic in Kansas earlier this week. There are some U.S.-based producers of graphite, aren't there?
Yeah, there are, and the domestic graphite production is increasing. Tesla, among many other companies, were lobbying against these tariffs in the early stages, claiming that the graphite quality or the graphite quantity was not at the stage that they wanted, at least at that stage. However, eventually these graphite tariffs are going to incentivize local production, but we do remain to see whether this graphite is going to be enough to meet demand. And of low cost in order to meet many cost targets that battery manufacturers and automakers have in the U.S.
Evelina, right now, what is the biggest headwind or factor for the EV battery supply chain? We focused on graphite, but there are many other things happening around the world right now.
Yeah, absolutely. It's definitely a time where a lot of things are changing when it comes to policy that is impacting both EVs and batteries in the U.S. Right now, I think the challenge is going to be figuring out the supply chain and choosing suppliers in order to comply and try to qualify for many of the important tax credits. As now there are new restrictions around where many of these components can be sourced. So I think this is going to be top of mind for a lot of the players in the U.S. Because this push to source everything domestically and to manufacture everything domestically might come with a cost to consumers.
Evelina Stoicu of Bloomberg New Energy Finance, Bloomberg NEF. Great to have you on the program. Thank you very much. So that does it for this edition of Bloomberg Tech. What a week it's been, from policy to politics, AI to everything else in between. Don't forget to recap the show on the podcast. You know where to find it. It's on all the Bloomberg platforms as well as online on Apple, Spotify, and iHeart. Shep said it just a minute ago, but next week it's all eyes on Washington, D.C. Pay close attention and always do it here on Bloomberg Tech.